Thank you, Peggy, and I want to take the opportunity to thank my colleagues, starting from Raviv, Yaniv, Phil, Elad, and Ron. Let me try and summarize for us how it all comes together, what you've seen throughout the day. So we are focusing, obviously, on sustainable shareholder value. We are delivering against plans with consistent execution and disciplined capital allocation. To be more specific, we will be accelerating our growth of differentiated specialties business. We will be prioritizing capital and R&D investments to support high return on growth initiatives. We will be driving operational efficiencies and value chain excellence to remain ahead of competition. We will be maintaining our industry return to shareholders throughout the life of the plan. We will be targeting timely opportunities for strategic M&A, and we will be optimizing sustainability efforts and risk management. We are targeting more than $2 billion specialty EBITDA business, up 100% with a CAGR of 16%. To be more specific and shed some color on our plans, our sales will grow substantially from about $7 billion all the way to $12.8 billion during the life of the plan. Growth on the specialty business will be 13% CAGR. At the same time, on commodities will be 5% CAGR. In EBITDA terms, we'll be growing our EBITDA from $1.7 billion all the way to $3.6 billion. On the specialty business side, we'll be growing at a CAGR of 16%. On the commodity side, our CAGR will be 10%. In terms of margin, we will be growing the EBITDA margin from 24% all the way to 28%. Our return to our shareholders. First of all, on our adjusted earnings per share, as you can see, massive growth from 2020 with just 20 cents adjusted EPS all the way to $1.50 in the trailing 12 months. Our dividend yield has also grown significantly from 2.7% in 2020 all the way to 8% in the trailing 12 months. We are driving efficiencies. The efficiencies, as you can see, our G&A expense improvement, we are down from 4.6% in 2020 all the way to 3.1% in our trailing 12 months. And our operational excellence savings of $320 million are embedded in our new 5-year plan. On the sustainability front, we are at the forefront of sustainability with TCFD disclosure. We are early adopters of the disclosures, and we're enhancing the management of climate-related risks and opportunities. We are also utilizing the sustainability-linked financing. We're on track to achieve sustainability-linked loans KPIs. When we look at the CapEx that has been put in place in order to support our strategies, we are targeting high growth of the specialty businesses. We are investing in growth, expanding capacity for growing specialties business. At the same time, in ESG, we are the industry leader focused on continuous improvement. On maintenance, we are investing in safety and efficiencies that are foundational and non-negotiable. And of course, we are leaving space for M&A. We are targeting timely opportunities for strategic M&As. Our return on invested capital has also grown substantially, or will grow during the life of the plan, all the way from 13% to 18%. On the divisional side, in the industrial products, we will be growing from 28% to 34%. On the phosphate specialties, we will be growing from 14% to 21%. In growing solutions, from 10% to 19%. On the commodity side, we will be growing from 10% to 13% return on invested capital. Looking at our financial position, it's a very compelling one and supports accelerated strategy execution. As you can see on the left-hand side, our net debt to EBITDA ratio has gone down dramatically from 2.3 in 2020 all the way to 0.6 at the current time. We're well within our bank covenants, of course, and well within the rating agency's profile, and we are stable outlook, BBB- on both S&P and Fitch ratings. Translating this financial position gives us compelling financial flexibility, ability to fund growth and plans, and deliver shareholder return at the same time. Our firepower is in place to move forward and deliver increasing shareholders' returns. Just before I leave you, I want to reiterate the ICL new 5-year plan. We delivered what we promised in 2020, much sooner than expected, with strong momentum. There are significant opportunities for ICL amid growing global sustainability challenges. We have the right fundamentals and are well positioned to achieve expected growth and margin expansion plans. Translating it into numbers, we are targeting sales of $13 billion, that's 11% CAGR, and EBITDA margin of 28%, that's 13% CAGR by 2027. By achieving that, we are on track to become a global leader in all 3 specialty businesses. Thank you.